Welcome to the Economics Observatory. I'm delighted today to be able to speak to Baron King of Lothbury, Mervyn King, who was Governor of the Bank of England from 2003 to 2013. He joined the Bank of England originally as Chief Economist in 1991, and then rose up the ranks of the bank to become Governor some 12 years later. Prior to that, he had an academic career of great merit, starting at Cambridge, moving to a chair in Birmingham, and then by 1984 he became Professor of Economics at the LSE and helped found the Financial Markets Group. And during that time as well, he wrote a very well regarded book with his friend John Kay on the British tax system, which I'll try not to embarrass Mervyn by mentioning, but I think I have already. It's something that I read as an undergraduate many years ago with great fondness. And I'm delighted to talk to him this afternoon. Mervyn, good afternoon.
Well, good afternoon, Jagjit, and it's a pleasure to join you.
We come to you today having just written another book with John Kay on the topic of radical uncertainty. And it's hard to think of a book that could be more apposite given the situation we're now in. Uncertainty seems to be everywhere in the middle of this crisis, in the extent to which the policymakers are responding to the crisis, and the way people out there are thinking about where the economy might go. Everyone is using the word uncertainty. So how can radical uncertainty guide policymakers at this very difficult time?
I think that where we are today, COVID-19, is a classic example of what John Kay and I call radical uncertainty, in that we know something about what's going on. We knew that pandemics could occur, but we didn't know enough to be able to attach any probability to any well-defined events, such as a virus coming out of Wuhan in December 2019. But we shouldn't have been surprised that at some point we were going to face a pandemic, and indeed we wrote that in the book, that we should expect to be hit by an epidemic of an infectious disease. So the question is, how do you behave in a situation like this, where you don't know enough to attach probabilities to events or to quantify the degree of uncertainty? And I think the two lessons that we drew from the possibility of pandemics are, first of all, that you need to prepare for the fact that it was likely that at some point we would be hit by an epidemic. And that means that you need to put in place measures to ensure that the economy and the health system in particular are resilient and robust with respect to such possible outcomes. You don't want to run things right up to the limit. That's what we did with the financial system before 2008. And we learned the importance of resilience of the financial system then. Sadly, we didn't carry it over to the health system or other parts of the economy. And the second lesson, I think, is that when you're actually hit by such an event, it's very important not to pretend to know more than in fact you do. And you should really be asking yourself the question all the time, what is going on here? Because the world isn't just a sequence of events driven by a common underlying probability distribution. The world is, to be technical, non-stationary. Stuff happens, and you need to actually ask yourself the question, so, what is the right way of thinking about the current set of circumstances? And I think policymakers probably feel under enormous pressure to pretend that they have the right answer, that they know that the course of action they're pursuing is the right one and the only right course of action to pursue. But in fact, in practice, we are navigating our way through a difficult situation in which we're learning all the time. We're learning each week more about the virus. We're learning about the response of individuals to the lockdown measures that were put in place. We're learning about how people are reacting as the restrictions gradually are being eased. But we don't know these parameters, which are crucial for the models that are being used. And in many ways, I think the failure of the epidemiological models to make accurate predictions is exactly what one would expect from looking at the same failures of prediction of economic models. These models can be very useful in understanding qualitatively the nature of the problem we're facing. But if you don't know key parameters, and we didn't know that much about the virus, we didn't know its fatality rate, for example, we didn't know the speed at which it was being transmitted at the beginning. We certainly didn't know how individuals were going to react to the lockdown or how they're going to react now to the easing of the lockdown. And these parameters are crucial in making any forecasts. There was only one moment in this crisis when at one of the daily press conferences, Chris Whitty, the chief medical officer, actually said in response to a question from a journalist, who asked him how many deaths were they going to be, he said, "I don't know." And that was an honest answer. And I think we ought to have heard a lot more about that as we went through it, instead of being told, this is what you have to do because this is what the science tells us we must do. There's no basis for that. The science doesn't tell us what we must do. It helps us to inform the key judgments that have to be made by being not putting enough restrictions in place. Then you get a wave of infections and large numbers of deaths. If, on the other hand, you're overcautious about that, you get very large costs in terms of reduction in incomes output and GDP. I think the right way to gain confidence amongst the public is actually to be prepared to say, I don't know at this stage, but we're going to try and find out what we need to know in order to set policy. And you should expect policy to change from week to week as we learn more. That, I think, is an honest way to not just to set policy, but actually to build up credibility in the policymakers themselves.
Some incredibly interesting insights there about the role of communication in policy, how to be honest about what we know and what we don't know. And I suppose one way of characterizing that is the difference between reassurance and realism. And there's always a danger with any policymaker going too far in one direction or the other. I'm kind of wondering, how can economics directly help the policymaking problem that we now have pick that right line between reassurance and realism?
I don't think that economic models or trying to describe the current situation by analogies with past recessions or depressions is remotely helpful. This is a one-off event. We should think about it in that way. What we know is that the big fall in output is not the result of private sector decisions. It's the result of a government-mandated shutdown. And that has very different implications for thinking about dealing with it. So if the government's trying to shut down the economy with one hand, there's no point trying to stimulate the economy with the other hand using conventional monetary and fiscal policy, because you don't want to stimulate the economy at that point. You need to wait until you're confident you can get rid of all the restrictions and then see how quickly we start to return to normal. So I think it is monitoring, it's watching what's going on, but most of all, telling a story, a narrative about what's happening, which recognizes that this downturn is not a conventional recession and shouldn't be treated as such.
If I could just take you back, say 12 years, and we think about the middle of the financial crisis, which you were instrumental in fighting off, and how you approached the shocks that we saw there. We could think of talking about the freezing of the interbanks in August 2007 or the collapse of Lehman's a year later. And I think you've said you went into that in the dark without models or data or things that could have guided you. And yet decisions were made. And I wonder how you came to those decisions at that time, at such a point of crisis then, when, unlike now, it was arguably the fault of the financial sector that had overreached itself. But I don't want to put a particular opinion in your own into your mouth. That's a view you might want to take as to what happened then. I just want to know how you approached it then.
So I think the ultimate causes of what happened were macroeconomic in terms of developments in the world economy and the significant disequilibria that had built up in terms of either too high or too low saving rates. And one of the things that the models were not helpful in considering at the time were balance sheet variables. Most of the macroeconomic variables and models that were being used simply didn't really give enough weight to balance sheet considerations. That was one very important factor. Another was that the world is non-stationary, and the idea that there is a model which you can use in any circumstance to explain what's going on, I think is a dangerous illusion. And in particular, it gave rise to common mistakes that were made at the time when people talked about, well, this is a 25 standard deviation event. Well, that was absurd. It certainly wasn't. It was an event that could not be explained at all by the models for which it was only a 25 standard deviation event. So I think, again, getting away from the idea that you just have one model, that you use that to make predictions in all circumstances, to use lessons from both theory and history. So there was a well-developed set of theories about bank runs. I remember, for example, trying to point out to Alistair Darling that because of our less than 100% deposit insurance scheme, the fact that there was a run on Northern Rock meant that it was rational for other people to join it. He didn't find that a helpful comment, but the point of it was to say, unless you guarantee those deposits now, that run is likely to continue. And it took them another 3 days before they got round to finding a way to guarantee the deposits. So that's where theory helped, but I think financial history was in many ways even more important because there were examples going back to 1914 about the importance of stigma in determining whether banks were willing to accept lending from the central bank. So, in September 2007, we found that although we had a brand new scheme for providing liquidity to commercial banks, which not only had completely smoothed out the volatility of overnight interest rates, but allowed banks themselves to determine how much access to liquidity at the central bank they wanted. When the first auction came, the first moment came when they could state how much they wanted to have access at the central bank for the next month, banks didn't revise upwards, contrary to our expectations, and the reason was stigma. And that was something that history would have told you was a factor. It was a factor right through the whole crisis in every major country, and it's still a factor today. It's not a question of abandoning economics at all. It's not a question of using only numbers rather than theory. It's a question of telling a story, a narrative, which draws on potentially very abstract and theoretical models or history.
The suite of models available to us, episodes and experiences throughout recorded economic history, and the art of the policymaker is to make the correct abstraction, and even that may not be right. Is that one way of thinking about the problem?
The art of the economist advising those taking decisions is to be able to say, look, here's a model that may not be terribly helpful in understanding every aspect of what's going on, but it has numbers in it which enable us to add up. I mean, the great achievement of the macroeconometric models is that they impose adding up constraints. They give you a feel for what numbers are plausible and not. But you may need to go to a very abstract theoretical model, which may be mathematical or it may just be verbal, in order to get insights into what is going on. And the challenge is to get the most important insights from this variety of different sources. That's why, in many ways, experience as a policymaker is something not to be sneezed at.
Yes. No, I suppose that experience and judgment, in a sense of when something is really wrong and what needs to be done, and when something will wash away, I suppose can only come with years of watching things and deciding.
It's also a question, I think, of if you start out by saying, look, put the models to one side for the moment. Let's ask ourselves, what is actually going on here? What's the nature of the problem? And then if we can do that, then we can go away and use the models to throw light on it. So let me give you one of my favorite examples of this, which is that when AIDS started to spread across Southern Africa, the World Health Organization was very concerned that they needed to be able to predict how quickly AIDS would spread through Southern Africa. So they built very complex demographic models and linked them all together. And then they did the sensible thing, which is to invite Bob May, who was formerly government scientist here. He and Roy Anderson literally wrote the textbook on infectious diseases. And he went out there to look at their models. And he looked at the model. He said, before you go any further, he said, there's one variable that's clearly crucial in generating the results. And it was the average number of sexual contacts per person per year.
Right.
And he said, well, you've got a number for it, about 100. And he said, but don't you realize that it makes an enormous difference whether that 100 is with one person or with 100 different people? If it's the former, AIDS won't spread. If it's the latter, it will spread very rapidly. Right. So what he did was to get them to focus on understanding more about this number, because there were a large number of people driving lorries across southern Africa where the answer was closer to 100 different people than to one person. That's how the disease was being spread. And the complex demographic models were maybe icing on the cake, but they certainly weren't relevant to answering the big policy question.
I want to move a little bit further back in time to another big policy question, a quest in the 1990s ultimately for operational central bank independence, which was achieved in May 1997. I suppose that itself is something that came out of both theory and practice, and was something I think was almost set as a at least internal objective for the bank at that time. And I want to know, how important was that, do you think, subsequently in terms of the economic management of this country? Is it something that will be looked back on as a historic development, or something that will slowly fade away as time goes on and other parts of the political system re-engage with things that the bank is currently operationally independent for?
So I think it was an historic achievement. It came out of a period in which, initially in the post-war period, because people believed that the government was capable of maintaining full employment, that investment was fairly buoyant, and indeed these expectations were self-fulfilling. So we had cycles, but they were relatively small cycles. But then we got into the period after the collapse of Bretton Woods, when inflation took off. And it proved immensely difficult to put in place a domestic monetary framework which could be described in terms of a single variable that could be a target for policy. And so governments kept struggling. And in the end, we abandoned it, including membership of the exchange rate mechanism that we were forced out of in September 1992. And we had to develop a domestic monetary framework. And I recommended an inflation target. We implemented it. And then we started publishing our inflation report. And the whole essence behind it was to get away from a purely mechanistic approach, to say that there will be discretion needed as we ask the question each month, each quarter, each year, what's going on here? How is the economy behaving? What do the monetary aggregates tell us? What are the information on output and demand tell us? And the point was to have an institution that generated a running commentary on the economy, which, although we would say on many occasions, we don't know. People would say, well, where will interest rates be in 6 months' time? We'd say, we don't know. And over time, we built up a degree of credibility and a reputation, not for making fantastic forecasts necessarily, because all forecasts are going to be wrong, but for understanding what was going on in the economy, at least as well, if better than anyone else. And that's why, in the end, I think that Gordon Brown and Tony Blair were content to hand over control of interest rates to the Bank of England. And I think it was a great success, because, you know, afterwards, when I would travel around the country speaking to businesses in various places, very often someone would come up and say, you know, I didn't really agree with your last decision, but what I'm very glad is that the arguments I would have made were put on the table. We can see that from the minutes. They were debated, and by a majority vote, you took a different view. But at least this is the right kind of decision-making process. Yes. And I'm very glad that you are taking the decisions on interest rates. So I think there was a high degree of support for that process. Majority decision of 9 people acting as individuals, but communicating with each other. And that communication was fundamental in trying to improve our understanding of the economy. We weren't just learning in isolation. in our own
Mm.
studies. We were learning by talking to each other. And that was a fundamental part of it. And I think it's been immensely successful. We're now in a world where I think monetary policy is not the major policy instrument available to us. Governments really have to deal with getting us out of this crisis. So the risk is that central banks try and do more than in fact they should be doing at this stage. And they are taking decisions which could be construed as quasi-fiscal decisions. And the big uncertainty about the future, I think, is whether if central banks do that in the way that the Federal Reserve probably is today, whether politicians, parliamentarians of the future will say, well, the actions taken by central banks were the right actions, but they shouldn't have been the people taking the decisions. They were allocating credit to particular localities, communities, businesses, regions, industries. That's for us to do, not central banks. And therefore, they may want to take back some of the decision-making power that has previously been given to central banks. Now, I don't think that's the most likely outcome, because I think the regime of independent central banks has been very successful. But it's a possibility, and it's a bigger risk looking ahead than it has been in the past 15, 20 years.
Policymakers need to be clear about what they don't know. Is it then also the case that central banks need to, from time to time, tell the politicians that they can't do something, that they need to say, no, this is outside of my realm of competence. It's something you've got to do as a politician, not me as a central banker?
Certainly when I was at the bank, we tried very hard to make clear to government that there were certain things we were willing to do as their agent, but not to take responsibility as the principal, because the decisions were about allocating credit and so on. So they backed, in one or two cases, one or two cabinet ministers had pet projects they wanted us to finance. And we said, well, you better go and discuss that with the Chancellor of the Exchequer. And then we heard no more about it. Something that's been thrust on central banks. And when there is a problem, when there is any sudden shortfall of economic growth, then the view is that actually, governments have to let central banks enter the stage with very drastic actions. And this is a mistake, because the sort of actions that central banks can take, particularly in terms of either interest rate cuts or QE, printing money in other words, are really all to do with handling relatively short-term counter-cyclical challenges. I think in many ways the best example of a central bank that has been trapped by being called the only game in town is the European Central Bank. The ECB itself has always gone to great lengths to say, you cannot expect us to solve the problems of an incomplete monetary union. We are a central bank. You politicians, governments, need to complete the architecture of a monetary union. And governments have consistently refused to do that. They kick the can down the road. And as a result, the ECB feels it's been under great pressure to take actions which it would not wish to have to do, but it probably feels it has to in order to keep the euro area together. But this is not a potentially long-run equilibrium that can survive, in my view. I think at some point the politicians can't just kick the can down the road, but will have to face up to the fact that either they are going to complete the monetary union by having a fiscal union, or they have to go back and genuinely maintain the description of the monetary union with which they embarked on the project, namely a unique experiment in which each individual government was going to be responsible for its own public finances, or they have to realize that they can't maintain the survival of the project indefinitely. But the ECB has been given the responsibility, and many people in the press, media, feel that the ECB should be taking these steps because they want to believe in the survival of the long-run project. But really, only governments can face up to it. And I think the risk to the ECB is that by taking very political steps, which are very akin to creating a fiscal union, then one day electors and voters around the euro area will say, but who are these people? We never voted for them. We could never throw them out of office if they did badly. Why have we been suddenly thrown into this situation? We want a democratic vote on whether we want to be in a fiscal union or not. And that, I think, poses the biggest risk to the independence of the ECB.
Central banks are all about helping the economy adjust to a short-term shock, and we want the politicians to set the framework for the long run, the supply side, the reforms, the public finances, and take responsibility for that. And I suppose for a long sequence now, we just haven't had those kinds of politicians in place. And it seems to me that into that vacuum, we've repeatedly turned to central banks, and that is the danger that you're outlining to us today.
Yes, absolutely. So when the bank became independent, it was very clear that we had a well-defined mandate, that we were given the inflation target by the government or by Parliament, and that we thought was the right thing to do. We didn't think that we should create our own target. And there was a very clear division of responsibilities. What's happened since, I think, is that whenever things appear to go wrong, politicians are, they know what they would like to see happen, but they don't want to take responsibility for it themselves. They would like to see an independent central bank take those actions, because if things did go wrong, then they have an alibi, they've got someone to blame.
I want to sort of go back and ask you why you decided to move away from academia. Of course, you continued to publish when you were at the Bank of England and had tremendous impact anyway in academia. But why did you want to shift from academia to policy? Why was that so attractive at that time for you?
Well, in many ways, I didn't make that decision. If we go back, so I joined the bank, as you said, in 1991. A year or so earlier, I had been given the chance to become the Deputy Chief Economic Advisor at the Treasury, because I had been doing a great deal of work on tax reform, and I was keen to be able to see that continued. But I turned that opportunity down. I said no to that. Instead, I was in the middle of writing a book, which in the end never really came to light. Then I was given the chance to go and be Chief Economist at the Bank of England, and I got a very good piece of advice from a friend who was in the Treasury at the time, who said, make sure you go as an executive director. Don't take any status below that. So I did. And I was appointed by Robin Lee Pemberton as Chief Economist. And I had time to get my feet under the desk in the bank, get to know people. I knew what I wanted to do in terms of reorganizing the research agenda to make sure it was relevant to what central bank responsibilities. And then came Black Wednesday and the departure from the exchange rate mechanism. And then I think it became clear that here was an opportunity to put forward a new framework. The people in the Treasury bought into it, and we implemented the inflation target. So although originally I'd gone to the Bank of England with no more than 3 years, probably only 2 years as my time horizon, when the inflation target came in and we had the inflation report, Eddie George, who was about to become governor, said, well, you can't really leave now. So I said, well, I will stay on to see the beginning of the inflation target and inflation report. And then it got to a point when I was just about to leave again. And then we got independence. And then I sat with Eddie George in the Bank of England on the day that he learnt about independence. It was the bank holiday Monday. And he and I were the only people in the bank, apart from those in the security room. And we sat in his office and he said, well, you can't leave now, we're going to be independent. So I stayed on. And then again, I was all ready to leave and I had my research plans in place. And then I was asked to be governor. And I thought long and hard about that, actually. I remember Gordon Brown invited me to a meeting. We sat around in the room, all his advisors and me, and he offered me the job. And I said, well, I'd like to think about it. And he was rather taken aback because he wanted to announce it in a speech in about 2 days' time. But I then generally walked around London for a couple of days. I was uncontactable by the Treasury. They were getting more and more frantic. And I really fought very hard because I knew it would be a change in my life, a big change in my life. And in the end, I thought, well, if I were to say no, in years to come, would I look back and deeply regret that? And having thought about that, I said, yes, I'll accept it and take it and give it a go. So I did, and I thoroughly enjoyed it. I don't think I can imagine a more enjoyable job than being governor of the Bank of England, because even though in some situations it appears to be very difficult, either COVID-19 now or the financial crisis back in 2007 through from then on to the end of my term, really. The support, particularly from the younger economists in the bank, working close to me, my private secretary as economic assistant, was so good that there was never a point when I felt the job was stressful, because we had a very difficult long day and people were working very late at night or through the night. The next day we'd make sure there was always a good opportunity to have a laugh. There's always some black humor that would come in the crisis. And a sense of humor was fundamental to getting through it. And I think the team of young people were absolutely outstanding. And that's what made my job easy. Well, I knew when I left the office that whatever came up after I'd left, they would react to it in exactly the way I would want them to. And so it was not a stressful job at all. Being stressed is, losing your job and having the responsibility to support a family on your own and not knowing how to find another job. I spent exactly 22 years employed in the academic sector and 22 years employed at the bank.
That's a rather nice symmetry. Well,
yeah, so now I'm enjoying life again back in the world of ideas. And I must say, it's jolly nice to have time to talk to you, Jagjit, and to be able to read and think. I think we're privileged to have jobs that actually function well in COVID-19.
Absolutely. We feel very fortunate every day to have time to reflect and think and talk to people such as yourself again. It's been a wonderful period to talk to you this afternoon. Thank you very much, Mervyn King of Loughborough. We're very fortunate to have had you as Governor and all the insights that you're now continuing to give us. So thank you for joining us. Thank you for the interview, and we'll catch up again very soon. Thank you, Mervyn. Goodbye.
It's my pleasure. Thank you very much. Goodbye.